Now, as we turn to the U.S., as I was joking with my producer before, is we need your help, obviously growing the channel. So please share this, like it, comment. We always enjoy the comments back and forth. So it's just helping us obviously grow our viewership and keeping everything free and keeping us driving harder, trying to pull together all this data. So now when we look at bond volatility, this is the MOVE index, which is it's calculated at the end of the day. So I don't have the 12th data in here, but you can see just where that elevated piece remains. And that is, again, driving things higher, putting more pressure, because if the US, which is obviously kind of, not kind of, but is deemed the risk-free rate that a lot of things are based off of, well, if the risk-free asset is seen as kind of volatility, what does a riskier asset see? Which is what we've continued to talk about as the pain for emerging markets as they go to borrow, as they go to roll their debt and try to just keep things moving. And this is why even at the most basic level of the BOJ, of the BOE, the Bank of Japan, the Bank of England are facing real problems on their currency, on their bond availability, liquidity. And if these countries, these developed countries are seeing the problems, what is Nigeria seeing? What is, the ASEAN nations seeing? And that's, again, why the problems that are out there, while estimates are coming down, they're still not reflective of the problems that are existing in the financial world, in the economic and consumer backdrop. Which is why when you start looking at who is doing what, well, people are still selling treasury holdings. People are still, and you look at the net sellers, we have net sellers, not net buyers when you're looking at the treasury. So right now, and as we've said the previously, over the last 30 years, we have had China, Japan, and the Fed as the three largest buyers of U.S. bonds, U.S. government treasuries. But now, with those three entities, the largest sellers or net sellers, who is stepping in? And this comes back to a conversation we've had multiple times for those that have seen it. It's who is your buyer of last resort? That is always going to be the question when you look at something. And my whole point in 2020 and in 2021 was that central banks were no longer going to be the buyer of last resort. And there wasn't a country, if you just point to China, China has bailed out the world essentially since 2008 on 4 different occasions, and that's now over. So who is the buyer? It was China for a long time. Before that, it was Japan. And then between China and the Fed, you had this ability to continue to put paper into the market. But now, who's your buyer? And who is your entity? And at what price do you get people interested? And when people have asked me, Mark, where should I buy the 10-year? Should I buy the 10-year? And it's like, I get it. You look at it, it's like, well, it's close to 4%. That's really high. It's like now, in comparison to the last few years, yes. But when you go back through history, we're still very low. And as we said in 2020, and we wrote the article in 2021, the bond bull market is dead. And nothing dies in a straight line. Everything gets, moves back and forth. But we've been in a 40, 50-year bond bull market that is coming to a close. And I think people need to come to terms with that. And that's where we continue to see a lot of these pressure points, which is why when you go back in history, it's rare to see the Fed hiking rates as the leading economic index has fallen by at least 1% year over year, like today. Most instances of a falling leading economic index were accompanied by rate pauses or cuts. But the 1970s were similar to today, which is what we keep comparing things to, because they put themselves in a position where they had to raise rates even as pressure was getting worse on the leading economic index, especially as we had broad shortfalls. We had issues in terms of availability of supplies, availability of equipment and raw materials. And that's where we draw a lot of those parallels, which is why we're not just sitting here just finger to the wind saying, this feels like the 70s. No, there is actual data that is supporting our view. And I went through a lot of that in our insights on Friday, looking at, there is a lot of comparisons and why this is going to be something similar, which Powell understands. And that's why when anyone who's looking for a pivot, you can see there was a pivot in the 70s, and it created one of the largest runs in inflation and a wage spiral, which is why they may stop raising rates in 2023, but they're not cutting them. It's going to be a raise and pause, which I think is way more likely. And I think it's interesting to see this view from Vander Research, which I agree with. When you look at this aggressive rate hike, this aggressive move higher, history of Fed hiking cycles since 1983 to give you an idea of where we are. But when you consider that the 22 Fed hiking cycle is the most aggressive in 40 years, but even more unique is that the Fed wants to keep rates on hold for over 12 months. They usually start cutting within 6 months of the last hike. Closest example of a higher for longer is 04 to 06, and that led to a move lower in the dollar, which then created countries which started to issue dollar-denominated debt. And that was when, so yes, there's similarities, but then when you look at the dollar-denominated debt, that's the curveball that comes in when you're looking at it compared to 04 or 06. You have a beholden buyer at this point. At the moment, we do think that people start to default on that, and then that would release more dollars, but that's more of a 24 to 25 event, where we do see dollar decline and dollar pressure as some of those euro dollars come back. But I think it's interesting to see that realistically we're going to get that pause and that hold at a much higher level, because if you go back to the 70s, which this one doesn't go into, they started to cut, and they started to cut because you had inflation slowing down, and their view was that it was going to continue, and then there was a shift rapidly, and then there was a huge acceleration in inflation because they started too soon. And I think that they would rather be there too long than not long enough, because being there not long enough creates even more issues, which again, we saw with what Volcker tried to get in front of, which is where when you're starting to look at the Fed futures curve, you're seeing that move up and you're seeing that, a shift higher. But then when you look at the assets, so when you look at the mortgage-backed securities and the treasury securities, you see that the Fed is selling down some of their balance sheet. But look how slow it is, especially on the MBS side. There's still, and I was having a conversation because I'm doing a roundtable discussion October 20th. For anybody who's interested in attending, just reach out. It's going to be in New York City at 90 Park. But when you look at this, you can see that it's not that they're tightening, but they're not aggressively tightening. Like, it's not like we're seeing this huge shift and this big drop down. They're still in a very in a bit of a dovish stance. Obviously not as dovish as before, but there's going to be that acceleration, especially on the MBS side, and that's where we see more pressure on the housing front. So then when you look at the U.S. corporate and investment grade bond index, you can see just how aggressive rates have gone because, again, the volatility is blowing things out. And this is what I was trying to tell people all last year, was that you were going to get a huge change in rates. You were going to get a massive adjustment in terms of that rate of change, because it was going to be all at once, because people kept trying to fight the Fed. The Fed was waiting too long. And again, as we were saying last year, the sooner they start, the better position we can be in. But obviously here we are. Now, when you look at the Hussman Strategic Advisors, what they put out, the estimates based on purchase of on-the-run Treasury and agency securities having an average 10-year maturity, the Fed is actually underwater. So they're losing money on all of their sales because prices have come down, because remember, prices and yield are inverse. So if you mark to market their book, they're now negative for what it is. And again, that's relative in terms of speaking, but it's just an interesting backdrop when you look at how they're now going to take pain doing this. And this is, again, there's so many issues and intricacies when you're evaluating these markets. And then the financial conditions index continues to get tighter. U.S. financial conditions index is now the tightest since March 2020. And then when you go back through time, the tightest since 2015, tightest since 2010. And again, we see that continuing to go higher and not stopping. And then the indicated value, when you look at conditions tighter than normal, and then the U.S. financial conditions, you can see that on a different metric. So the one on the left is looking at Goldman Sachs. The one on the right is looking at Barclays. You can see that we're actually above where we were in 2020. So it's all relative, because each one is going to use a different algorithm, a different weightings in terms of the math that they're using, but you're still seeing the trend is obviously the same across both. So then when you look at quantitative tightening causing money supply collapse, the monetary base. So yes, we have come into a negative M2 growth rate when you look at it. But when you look at the balance of it, we just look at how much money got pushed into the market and how we're just now getting to the point where we're getting some decent drawdown of the liquidity side, and how everything's seizing up. And you get an idea of just how drunk on, or as we've been talking about, this is a drug addict looking for their next hit, continues to tighten, continues to just get their next fix. And now that it's gone, you're seeing this, let's call it a taper tantrum, which we're fully in taper, and the tantrum is only accelerating. And for anyone that has a child, first they start with no, then they say yes back to you louder and louder and louder until they fall on the floor and are kicking and screaming, and you're the most embarrassed you thought you could ever be, more than you ever thought possible, in the middle of a store with a screaming child. That is the market right now. So holdings of treasuries as a percentage of treasury debt outstanding, and this is the key piece when you look at the underlying components of who is owning this debt. As foreigners in the Federal Reserve fall, U.S. domestic is purchasing a bit more, but not to offset that drop. And now when we turn to inflationary drivers, so PPI came in hotter than expected. The headline was up 0.4% month over month. Core was up 0.4% month over month. So core never went negative, which we've been saying that core was never going to go down. It slowed. The rate of change came down, but now the rate of change is accelerating on top line and core. So then when you look at the different pieces, 8.5% year on year versus the estimate of 8.4%. And then when you look at excluding food and energy, came in at 7.2% versus the estimate of 7.3%. So now when you look at the different backdrops, you can see the acceleration. And when you look to prior, it's still right in line with last month, but it's above estimates. And this is what we've been talking about, where you were going to get some of this move lower, but then you were going to start to get this flatlining. And now as gasoline prices start to go back up, as heating oil prices go back up, as electricity prices go up, that's when all of a sudden you're not going to stop going down. You're not going to get this huge acceleration that we had obviously in 2021, but it doesn't mean you have to go down either. And again, giving way to that stagnation that we've been highlighting. Now, will China become the central bank's best ally? Typically we've been importing inflation in different ways, but it's interesting because when you look at the exports from China, they've been diminishing, and the imports from China that the U.S. has been bringing in has also been diminishing. So if you think about the 60s and 70s, we exported in inflation and we imported inflation. Now, as we reshore and onshore, we're importing inflation, and we're not really exporting anything in terms of inflation, deflation. So you're seeing that, yes, China is obviously a leading indicator. Yes, this is good to see where things are headed, but it's not the same ratio. It's not the same that we've seen in the past, which I think is going to disappoint people when they look at some of these numbers in general. And that one-to-one correlation that we had on the way up, I don't think we have on the way down. So when you look at core PPI goods, inflation is falling. But when you look at the US versus China, there is a long way to fall. And a lot of that China PPI on the manufactured side was driven by housing, was driven by things that were consumed internally. And they're not looking to export a lot of that benefit right now because they want to give it to their massively weakening consumer and the problems that they're trying to address internally. So then when you look at foreigners and the Federal Reserve in general, we just wanted to highlight again, remember, China is trying to manage themselves, and they're trying to do that by pulling in dollars, selling treasuries, which is accelerating and creating more of those problems. So even as we try to get in front of inflation, it's going to get harder and harder given who is buying our debt and how are we going to deal with those elevated interest rates. So now when you look at small businesses, there's a clear and swift rolling over in the number of small businesses seeing higher prices and expecting to raise prices over the next 3 months. But it's still the highest it's been since for higher prices now. It's come down, yes, but it's still the highest it's ever been. And then when you look at the next 3 months, it's come down, but it's still the highest it's been since 2008. So yes, you're getting some normalcy. And we've been talking about how you will, as the supply chain catches up, some of those costs come down. But look at how the rate of change is flatlining. And that's the biggest issue because some of those things are adjusting from the wages side. So small businesses pulling back on plans for raising compensation. So they are slowing down, but you can still see it's still high. And then when you look at some of the leading indicators, it's slowing, but it's not stopping because the participation rate, as we talked about on Friday, came down again. So even though job openings came down, there's still not a lot of people looking for jobs, which is keeping that delta wide open and, again, keeping pressure on some of those wages. And the single most important thing for companies still remains inflation. We don't see that changing. Quality of labor has kind of flatlined, but it's still a problem. So inflation and quality of labor are two key things. And the Fed has been raising rates. And by raising rates, they should have helped address those two pieces. And clearly, again, they're not able to get in front of it, which is why, again, rates are going up and going to stay higher. September small business optimism index rose to 92.1 versus the estimate of 91.6. But the outlook ticked down slightly. Hiring plans picked up. So again, you're starting to see kind of that mix. But the outlook is still at the lowest it's been since 2012. And it's still well below where we were during COVID. And those are some of the issues that we continue to see as we project into those leading indicators into the future as a direction. Small business optimism, as you can see, sales expectations recovered a bit, still negative. So again, you're still dealing with a negative trajectory as inventory satisfaction has started to come down, which means they're going to have to go out and purchase, which will be good because prices have come down a bit, but they're still elevated. So you're still going to bring in inventory that is at a higher price that you're going to have to try to pass on in some shape, way, or form. And then when you look at the job openings hard to fill, it's come down, but going back to 2006, it's still the highest it's ever been. So yes, it's come down, but it's all relative, and you have to look at it on a broader time scale to say, okay, well, yes, it's come down, but it's still massively elevated, keeping those wages higher, and why there's still a lot more work for the Fed to do. While compensation plans come down, plans over the next 3 months also coming down. But again, look at where they're coming down into and how it's still on the elevated side. But then when you look at inventory in a different way, an inventory to sales ratio at U.S. general merchandise stores still at a very high level going back through 2018. So you're still going to get sales. You're still going to try to get people in the store. All the while, core service inflation and service wage growth remains in an upward trajectory, which as we go into tomorrow for the consumer price index, we still see a huge increase, a stable increase in inflation. Again, slower rate of change, but still higher and driving higher, again, leading to more problems going forward. So that's what we have for you in this segment. In the next segment, we're going to go deeper into the consumer spending side and where those red flags are really cropping up.